Thank you for dialing into today's webinar from Sundaram Mutual Fund. I am Sunil Subramaniam, the Managing Director. So let me kick off without much ado. An update on the global economy. For those of you who attended last time's webinar, you'll be aware of the impact of COVID and what it did to the economy. Taking on from there, the response, as you may recollect, was that the Fed and the ECB and the central bankers adopted massive rate cuts and massive monetary stimulus to attack the problem. The extent of the rate cuts you can see from here, that at a level of around 200 basis points in December 2018, there's been a 177 basis points drop. So money is now extremely cheap and available as in a method and a bid to resuscitate the economy. The second aspect is the quantum of note printing that they did. The four central banks, the four big countries of the world, expanded their balance sheet by 29% of their GDP. So that's, again, as you can see, it's a massive, it's almost like the world is expanding it by a full 30%, right? So these two effects, right, were then supported by the government through form of a massive fiscal stimulus, which is directly impacting the economy, right? So that was also done in a very large and sizable manner of almost 4% of the world's GDP is being now thrown at this COVID crisis problem, right? And the nature of the support also that was given is mostly on the supply side, because the idea was the coronavirus had affected supply side, and if you attack that, then you can see a recovery in a much quicker time frame, right? So now, how is this post-COVID world shaping up as a result of these three efforts done by the bankers as well as the governments, right? So there are significant green shoots becoming visible all across the developed world. So the first is, if you look at the driving trends, right? So right up to end July, we have taken this, and as you can see, after the fall in terms of the lockdown, you're seeing now that gradually there is an uptrend. So clear V is forming in terms of the driving trends of self people and also those on transiting from city to city. Even there, as you can see, there is a V-shaped formation, right? And then when you come to the supply side, manufacturing is key. So you take a number of the US states, they all maintain their manufacturing indices. All of them, I hope you can clearly see the V-shaped recovery, right? And then when you go to consumer sentiment, based on the fact that these jobs have been protected, even that is showing a recovery. So clearly I'm showing you trends across the US and the developed world, which are showing a uptick in activity. So here are the restaurant bookings in Australia, Germany, Canada, and the United States, all showing a revival, right? And global scheduled flights. As you know, the airline sector is one of the most deeply affected by lockdowns. Sharp fall was seen, and gradually, yes, it's not yet a full V, it's just slowly rising up from a valley, right? And one of the ways to expect a V-shaped recovery is this data, I must tell you, is not about the current period. This data is about the previous crisis. The reason I brought out this slide is for a specific reason, that you can see that in the previous crisis, well before unemployment recovered, personal consumption expenditure recovered. Why I'm saying this is, unemployment is about the mass. So even if the lowest laborer is not getting his job, the people at the high end start consuming. So it doesn't mean that you have to wait for full employment to come through before consumption comes through. Very well before that, you can see a pickup. That's what, even at the bottom of the line, you can see higher incomes account for a larger share of consumption, and hence you can expect a V-shaped recovery. And one of the final factors from an American market perspective is that during the global financial crisis, about 97% was the US household debt as a percentage of GDP. Today, that is only 74%. So it gives you enough headroom for people to use their credit cards, take short-term loans from the banks to go and consume whatever they want to consume. So all factors supportive of a V-shaped recovery. But let's drive our attention to China for some time. The reason I'm going to go to China is because China had the crisis first and also is posting the recovery first. So in a sense, they are a bellwether for world recovery. So in China, as you can see, there are a number of industry and services things, high frequency indicators like cement shipment, electricity production, property sales, auto sales, domestic flights. all of them, can you see, are posting a very sharp V-shaped recovery. So while China is not exactly the most popular country in the world today, the fact of the matter is that China is a kind of lead indicator of the world, because ultimately China exports a lot, and what they are manufacturing is bought by people in other countries too. And this is the services sector. And as you can see from the green color, right, the number of services related indicators which are going to go back to pre-COVID levels is significant. Only one or two cinema halls are still at red. Otherwise, you see by the end of this year, you expect China to be fully normal. So as a result of this, the China's manufacturing and services PMI, again demonstrating a V-shaped recovery. And if you now look at the fact that as China showed it, a few months later, the US and Euro are also showing a V-shaped PMI. I have a little more detailed slide on the PMI here, where you can clearly see from a low of April how May, June, and July have seen a sharp bounce back in manufacturing in America. The same is true of Europe, right? And naturally, China has been taken the lead and is already at a 50 plus for close to 3 to 4 months. So clearly, all of this points out to the fact that the global economy is on track for a V-shaped recovery as opposed to U-shaped in earlier crisis. And the reason for that, I'm just repeating here, in terms of lockdown used as an infection containment, vaccine and a cure, you're seeing lots of good news coming from lots of places about how near they are to a vaccine and a cure. So all of those further support the thought process of a V-shaped recovery. And to summarize then, right, the rate action, the monetary stimulus, the fiscal stimulus are expected to result in a V-shaped recovery in the GDP, which, as you can see here, as far as the world is concerned, this year is a recessionary year of minus 4.9. Next year, world is expected to bounce back to 5.4. And since we just discussed the advanced economies, the fall was the sharpest there at 8% negative this year, but they are going to bounce back to about 4.8 next year. While emerging economies, the fall was less, but the rise is also going to be better, right? Now, within the developed countries, if you look at the various countries there, United States, Euro, Japan, UK, and Canada, as you can see there, all of them, this year, the Euro and the UK are both going to see double-digit negative. United States at 8%, and Japan is the least affected from a minus 6%. But next year, if you see, though Japan is least affected, its bounce back also is the least. Whereas those economies which fell 10% are going to actually recover by 6 to 6.3%, as the data here shows. The V-shaped delta tells you how significant is this minus to plus shift, because all of this ultimately feeds into the stock market and other market. So just while we cover the globe, let's not forget India and China. And in this emerging market world, as you can see there, China this year itself is not going to be in a recession. They are going to post a positive 1% GDP growth. And next year, they are going to be the fastest growing country in the world at 8.2%. So clearly, markets are eagerly watching China to see how this pans out. India is not far behind. We had a very sharp fall, but our rise is also expected to be sharper. We will cover India in a little bit of detail in a later thing. So just to demonstrate that all these data minus to plus actually looks like a V, I'll put the whole thing together in terms of the world, emerging economies, China, all in a graph to show you how a V is actually likely on the GDP situation. So one more indicator, and which is where I wanted to show you, is the Baltic Dry Index. This is the actual ground level thing which gives you confidence of a V-shaped recovery, because the Baltic Dry Index is nothing but the rate of booking a ship to transport oil, coal, car, any kind of goods. So the indicator tells you how the future trade is going to look like. So the very powerful indicator, and as you can see here, from a 1090 level in December, pre-COVID crisis, it fell to a low of 600, almost a 40% correction. And it's now back doubled. So there clearly the V forms for you. Just one caution that all this V-shaped recovery, right? The V forms, but whether the V sustains as a V or maybe transforms into a W or flattens and then rises is up for grabs. And I would draw your attention here to the 1 month. The 1 month indicator actually has fallen 25%, which means of late there has been a resurgence of the virus in a lot of places and slight sort of slowdown. So I would also say that while a V is clearly there, the timing of the V, right, you need to be a little more patient and wait for that to happen. So moving from the global economy to the global markets, you're seeing the gradual return of risk, right? So what is that? The story is that the flows are reversing, which went away from risk assets back into risk assets in some form. So what is the reason for this? The reason is that the money which went out of mutual funds and ETFs when the crisis hit, right, has reached a level of minus 1% of the total outflows as a percentage of market cap. Previous recessions tell us that this minus 1% appears to be a floor. From here, always a bounce back appears. And that's where we are. And that's one of the another strong reason why the markets are bouncing back, because history says that minus 1% appears to be a true bottom for the outflows from the stock market. At the same time, in all of that liquidity that was there, low interest rates, lots of balance sheet expansion by the Fed and the ECB, that money has gone and sat in cash funds, in money market funds, which are pretty much zero interest rate. So as you can see from this graph, there's $3.4 trillion of cash waiting to shift either into risk or back into safety as the time passes by. So our estimate is that out of this $3.4 trillion, close to $2 trillion is got the potential to move into equities. Hence, equities should be showing a rise, which is what I wanted to show you. But first, because I told you that the Baltic index is showing a little bit of a correction, so you can see that gold continues to hold its charm, right? The safe haven, right? While from March to August, it has gone up 15%. Right? So clearly money is still following gold because there is still uncertainty on how long this recovery will take. But money which was going into the fixed income, US 10-year, is now started going out, which is a positive 0.54 positive return that you're seeing, means that money is going out of fixed income. That's why interest rates are rising. So that's one indicator there that I would like you to take a look at. And now when we move to equities, you can clearly see the V-shaped recovery, right? In March, you had the Dow 1-year return at minus 14%. The Nasdaq was flat at 0.6 and the S&P at minus 7. Today, you can see the change from minus 14 to plus 0.7, from 0.6 to 36.2. So on the right-hand side, the last column gives you the extent of the move. So clearly, the V-shaped economic recovery, the markets are discounting it with a V-shaped stock market recovery, right? So at the same time, emerging markets, which are the riskier than the US or developed markets, are still showing by and large an outflow, which means the American consumer, the developed market consumer who invests in ETFs, who invests in these, is still a little bit wary of taking that risk. So you're seeing that barring our country, India, and to some extent Taiwan, the rest of them have seen sharp outflows continuing in this year. So at this point in time, I'd like to show you that just because FII money is going out, right, it does not mean that those markets are not recovering, because there are local participants who are buying. So the emerging countries are also showing a V-shaped recovery is evidence from the fact that despite FII flows not being so strong, there are still V-shaped recoveries in the emerging market. Overall, MSCI emerging market has turned around to 28%, China by 28%, and India and South Korea by 30% plus. That's the change in the 1-year return. Yes, Singapore is not having a good time, and Hong Kong, is going through its troubles. But overall, the scenario of the world is of a V-shaped recovery in the economy, driving a V-shaped return to risk in terms of the asset classes. With that, I'd like to conclude this section of the global economy and the global markets. And now let's turn our focus onto our home country, India. So looking at the economic outlook for India, right? The first thing is that what did happen was that the government announced a 10.5% of GDP, 21 lakh crore of an Atmanirbhar program, but at a very minimal cost of 0.8%. They adopted a number of measures which use the word jugaad, as you may recollect from my last webinar. And these are the kind of steps that the government has taken in terms of Narega, in terms of support to cash flow starved businesses, and Kisan credit cards and other things for the agricultural sector. So how effective has been this relief package? So here, if you see on the left-hand side, we have listed out some of the measures, and the right-hand side, what is the progress on those measures, right? So for example, 3 lakh crores, 3 trillion means 3 lakh crores of collateral-free loans were given to MSMEs, permitted. About 40% have been sanctioned and 21% has been disbursed. So some progress, but not yet fully done. Same with the 45,000 crore partial credit guarantee schemes for non-banking finance companies. So you have now banks approving portfolio purchase of 31% and another 13% are in the negotiation stage. So pretty much 44% is done. 30,000 crores of working capital funding for farmers through NABARD, 83% has been disbursed. So clearly the farming sector has received the money quickly, right? And you then take housing finance companies and all who have got a special 30,000 crore liquidity scheme, about 33% has been received, the rest are under progress. And in terms of tax measures, the government has actually released 62,000 crores of tax refunds. So that's another way of providing money into the economy. So as you can see, this is a job partially done. There is still some more of the relief package to do, but there is progress, right? So that's with that in mind, right? Our lockdowns also have proved successful and we have moved steadily to unlock 1, 2, and 3. Yes, the COVID virus is coming up in new places, but by and large, I would say that we've done a fairly successful job of containing it, especially from certain segments of the country, such as rural India. So as you can see, the red are the containment zones are largely in the urban areas and the green is the rural India. So rural India has got back into business, right? With that in mind, right? Let's look at it as where are there green shoots visible and if so, what are they? So the first is, like I said, rural India is back in business. So from that perspective, as you can see, India has seen a sharp jump in its Kharif sowing. And record Rabi procurement was also there. So if you now look at this data, this tells you how Kharif sowing is progressing well, much better than last season, right? If you see week on week, right from 5th June, there has been a steady increase in the percentage of actual area sown. Then if you see percentage of Kharif as a proportion of the normal area sown, again, it's upwards of 60 to 70%, right? The other thing on rural India that you can see as a recovery stage is the registration of all motor vehicles. So the light blue line tells you what it was last year, and the blue line tells you that this year during the lockdown it crashed completely, and now it's begun to recover. So I think it's a very important point to bear in mind that it's rural India which is driving this. It's entry-level cars, it's two-wheelers, it's tractors, right? So the other thing is that government is actually spending a lot of money to reduce the drag. So you can see here the government receipts versus expenditure in the fiscal deficit. The government is actually increasing its expenditure. And if you look at it, against last year's 4.6% fiscal deficit, the first few months of this year, they're already running at 6%. So government has clearly also expanded its balance sheet to support the economy. And as a result of which, some of the payment, if you recollect, was a 40,000 crore increased allocation to Narega. So these are the migrants who have gone from urban back to rural, and the government is providing gainful employment to them. As you know, the Narega scheme says 100 rupees per day for 100 days in a year. So that has resulted in the job demand going up 40% YOY. So as a result today, in India, despite that fall, we are seeing that both urban and rural employment are back to the levels they were pre the lockdown and the crisis. So you can see there, 8th March, whatever was the level of unemployment, we are back at that level, largely due to rural India coming back on track. So unemployment has recovered, which is great news from our economic perspective, right? Then you take urban employment is there, but you take some other indicators, air traffic, car sales, Google's mobility report, petrol consumption, NPCI, National Payment Commission of India, financial trends. See, can you see the V shape clearly forming in lots of segments, right? And if you look at it, right, the V shape, you should see in mind that I've written the various indicators here and I've showed you 3 data in each set, which is May month, June month, and then July last week latest. So as you can see in each one of these, they are all negative, but they are less negative than before. So when we say V-shaped recovery, please remember that a lesser negative is also a V. Only things which are actually positive are television ads on this slide, and in the next slide are bank credit and bank deposit. All other things are still negative, but they are less negative than the previous month and the previous month. So the V is forming, but we are not yet in a growth situation. So kindly bear that caution in mind in terms of the word V. V is if from minus 30% goes to minus 20% is also a V-shaped recovery. The recovery is on track, and if this sustains, you will come into positive territory, right? And this again is a summary in a color form because it's easier to understand that from February, March, April, May, June, as you can see in April, everything was in red. So what does it mean? Red means in the bottom 10% of the growth rate and green means in the top 10%. So as you can see, April was the worst month. May is slightly improved in color. June was yellow and green with only one credit growth being red. And in July now, you have no reds. You have only greens and yellows and light greens, which means that the recovery is well on track, right? To that extent, right? Some other specific things which I want to show you were the interstate and intrastate e-way bill. As you know, government is now procuring only through e-way bill. So government's procurement, which also dropped in the month of April, both interstate and interstate have shown a V-shaped recovery, and daily electricity consumption. Yes, it goes up through spikes, but the overall trend is of a V-shaped recovery, right? And TV ads index, I showed you the data, I'm showing you the graph to picturize how the V is forming. But as you can see, there is a slight flattening at the end. So while the immediate bounce back, a relief rally after the lockdown and you unlock, you're opening up, there is immediately a relief to go and do the economy to really come back to normal, you'll have to give it a little more time, right? So this is again showing you the traffic congestion is picking up, right? Electronic toll collection at highways is showing the V-shaped recovery. Railway goods earning data, again the same kind of a thing in terms of April, May, June until 20th July. As you can see everywhere, the negatives are becoming less negatives, right? And finally, to summarize, we have come to what is called as the Nomura's Business Resumption Index. So as you can see, if you use 100 as a base for the normal economy, it had dropped to 68 in the month of March before the lockdown. The lockdown further brought it down to 45, and then as you unlock, you're coming gradually back, you've reached 70, which is well ahead of what it was pre-lockdown. But to come back to the original 100, you have to be patient and wait for a time. So the other thing which is improving is the COVID trajectory is showing some sign of improvement, right? The doubling of cases. As you can see, that is increasing in number of days to double, which means that though India today has the highest number of cases followed by US and Brazil in absolute number, we are actually in a easing trend, right? And the next one is the fatality rate. So again, there is some sign of improvement in the fatality rate, which had peaked and then it is dropping. So as a result of this, right, there is a expectation that the short to medium term itself, markets are expecting a V-shaped recovery. So this is again to demonstrate how the shape of the V looks. And in actual data terms, as I already showed you, from a minus 4.5%, it's likely to go to a plus 6% in the next calendar year. So that recovery is in fact better than the emerging economies and the world. So along with China, we are the two countries that are going to lead the recovery of the world. And as I said, this delta that we are going to show, in fact, is going to be even better than what China showed, because China is only a plus 1 to plus 8.2. We are actually going to go from minus 4.5 to a plus 6, right? So from this perspective, immediate next year recovery is already there. The markets are factoring in that. But before we look into that markets, I'd like to show you one more thing, that many FIIs who invest in our country are investing for the medium to long term. So in discussing the Indian economy, we'll be amiss if we do not look at the long-term implications for the Indian economy. So let me now look at the medium to long term. So in the long-term economic outlook, right, the China opportunity stares us in the face because India has strong structural advantage compared to China. What do I mean by this? China's red line, which is from 2017 onwards, its labor supply has started declining because of the one family, one child policy. India is still on a rising trend, and our decline starts only in the year 2050. So India is assured of good labor supply for the next 30 years. And quantify that in just the 2017 to 27, China loses 21 million people. We add 116 million people. So 6 times the amount that China is losing, we are adding, and no other country is anywhere near us. At the same time, the cost of our labor is also very cheap because China is at a $10,000 per capita income and we are at a $2,000 per capita income. So our labor is 5 times cheaper than China. So labor supply, long-term labor supply and cost are an advantage. And thanks to our technical education, the number of engineering colleges and medical colleges and pharma colleges that we have ample supply of advanced labor or moderately skilled labor or basic skilled labor. And compared to any of our competing countries, we have enough supply of labor for this. So from that point of view, for India, the other big advantage is what the Modi government has done in terms of improvement in the licensing, removing hurdles for new business to come in, improving the infrastructure for them to transport their goods, which is all reflected in the ease of doing business rankings, where India has seen a jump of 79 ranks over the last 5 years. So for a foreign manufacturer to look at China versus India, India has done a strong improvement in the ease of doing business. This is a big positive for the country. And to support it on the financial side, we used to have one of the highest tax rates in the world. We have brought it down to 25% for our existing companies, but 17% for new companies, new manufacturing companies, which is at par with the best in the world. Singapore is very close to us. So it makes India very attractive because on top of this low tax rate, we have also waived the dividend distribution tax, which for a foreign manufacturer is a very critical component because he can repatriate his capital only in the form of dividends, and by taxing it, you're actually reducing the profitability of his project. So this was a great thing in the budget to make us financially even attractive. As a result, you see now that FDI in India has become on a rising trend. So over the last 20 years, from a single digit, we have now moved to $60 to $70 billion per year of FDI inflows, and we account for 3.3% of the world share of FDI flows. And hence, because of that, we would say that financially, we'll give a rating to our attractiveness. People skills and availability, we give a rating, and for ease of doing business and business environment. You add up all the three, you can see that India is already among the most attractive countries globally for manufacturing to come in. And as a result of this, right, China, in addition to these structural disadvantages, COVID has made a big difference to companies which were manufacturing China to move out of China. So as you can see here, 44% of the people who are already manufacturing China say that COVID has increased their intention to relocate from China. So big, big positive. Next, when do they want to move it? That urgency has increased since December 2018. If you can see, 3 to 6 months, how many people have brought back their timeline? Originally, they were saying in 6 months I will do. Now they want to do it in 3 months. So this big change has again occurred because of COVID in terms of the urgency factor. The third factor is the quantity of production they would like to shift out of China. So as you can see, a moderate amount and a large amount is where you'll see the maximum change in the thought process in people who are making stuff in China. And finally, right, whether they're going to just pull out that factory and put it in or create new production outside China, that is also changed because they want to now set up new production facilities. As you can see there, those who are investing in new production outside mainland China is showing a sharp increase. So all of these factors make the China export likely to drop between $350 to $550 billion in the next few years. So taking an average of $450 billion, though India has done a lot of things to support this, Vietnam is in pole position to grab this advantage. So as you can see, we are expecting Vietnam to get 30% of the $450 billion into their country. India is a distant second at about $69 billion. But with all of these steps that are announced over the next year, we think that India can gain traction ahead of Vietnam and even become the #1 country. But lot of work ahead of us. We have done some taxation related stuff. We have done some use of doing stuff. But if you see, there are 15 to 20 factors which any company looks at when they want to relocate their factories, which are all laid out in this circular graph. And the most important ones are labor cost, land cost, and reduce trade war risk. India has a good score in most of those, but there are other key factors like policy support, better infrastructure, and easy supply chain access, which we need to work on to really capture this advantage, right? So one of the places where the opportunity was there, was being grabbed and then went away, and we are now trying to get it back. I'd like to focus on to show you the seriousness and the sincerity of the government in taking advantage of this opportunity. This is in the space of electronic exports. So as you can see here, right, the electronic exports and imports, right? So components being imported here, and from India, they were being exported out after being assembled here. So from 2018 September onwards, you saw the shift happen, but our exports started going up and imports started coming down because more of the manufacturing was coming to India. So clearly we had a great advantage, which we were taking advantage of right from 2018. And 30% was a year-over-year growth in the exports of electronics. But then came the COVID crisis, and in March, as you can see, that line dropped dramatically. So what was going on a very good wicket suddenly got challenged. So the government then has come up with this plan, most recently, of a $6.7 billion expenditure to boost electronic manufacturing and reverse this trend due to crisis. What is this? They aim to create pre-built factory shed manufacturing clusters that a company can immediately move on to, reducing the gestation period to start manufacturing. This comes because companies in China continue to look outside to reduce their constant risk on China. What actually this does is that it gives 4% to 6% of the incremental sales they do over the next 5 years as an incentive back. That's why that's $6.7 billion expenditure. But this was a short window to fast track this. So the scheme closed on 31st July, a few days ago. What happened in that scheme? 22 companies have filed their applications. Several international brands there, Samsung, Rising Star, Apple's phone manufacturers like Foxconn, Honhai, Wistron, Decathlon. And these two companies, 37% is Apple's sale value and Samsung is 22. So 60% of the world's mobile phone sale by value is just these two. And they are shifting their production to India. So naturally, this is going to be a huge bring for India. Close to 11 lakh crore of mobile devices and components are expected to be manufactured in India in the next 5 years. About 12 lakh job opportunities, 3 lakh direct and 9 lakh indirect jobs will be created. And value addition will be anywhere from 15 to 20% to 35 to 40%, right? For mobiles and 45 to 50% for electronics. So clearly a huge win for India for the whole Make in India program. I spent a little bit of time to tell you where the specific opportunities are and how the government, in fact, is acting to take advantage of it and quickly move there, right? So, plus, the government has also been doing the Atmanirbhar project, right? Apart from some steps to boost short-term demand like the Narega or whatever, have also done a lot of things which are important in the medium term, which are relevant to this China opportunity. What is that? These are the reforms that they've taken to ease up the supply side, right? Supply chain. Like say, what have they done? They have enabled commercial coal mining, ending the government's monopoly. They have given a boost to domestic defense production because they have allowed 76% FDI. They have privatized union territory and significant PSU reforms where, apart from some strategic sectors, they have opened up the public sector to the private. These are listed here, right? Much more detail. I'll leave it on for a minute for you to see while I just grab a bunch of water. And as we move on from this, what I wanted to show you is how the government has brilliantly taken advantage of these crises to push through what I have put in apostrophe as less likely reforms. So this table splits it into 4. The left-hand side is less likely, the right-hand side is more likely. And up and down is those which are high impact and those which are low impact. So that which is less likely and less impact, you don't need to worry. But the key point is that which has a high impact but was considered less likely because the opposition will oppose it, a lot of difficulties to do it. Because of this crisis, the opposition's attention is diverted to doing a lot of other things. So they have managed to push through very difficult, less likely reforms, which I've highlighted there in some form in blue. So, and in some of those in black. So this is the key, that the Atmanirbhar program actually has been a very medium-term positive because of the amount of reform it has introduced. Right? As a result, right, from a longer-term growth perspective, if you want to look at how the top 10 world's biggest economies, how that has changed in 1992, 2008, 24, 16-year periods, because for you to take a big shift. So 1992, US was number 1, China was number 10, India was nowhere. 2008, US remained number 1, but China leapfrogged from number 10 to number 3. What's going to happen from 2008 to 24, we are 3/4 of the way through, is that China is going to overtake everybody and become the number 1 largest economy in the world. US will drop to 2, but the surprise package is India, which is not in the top 10 in either 92 or in 2008, is going to do the biggest chalan and land at number 3. So we are all geared by the time the next election is due for India to be the 3rd largest economy in the world. So that's the big medium-term positive for a foreigner looking at India. With that, I come to the end of my Indian economy discussions. We covered both the short-term and the long-term economic impact. Let me now move to the stock market. And within the stock market, let us first address the issue of the sectors, because we just spoke about the economies. I think the sectoral performance is directly reflected in the earnings by the economy's performance, and the stock prices, either they take into account or don't take into account, we shall see. So first, just in the large cap sector, because FIS look at large caps, there are about 91 companies which have reported earnings. I'm talking about the earnings of the previous quarter, January, February, March. Why? Because this quarter has just started. You will see the earnings come through. But the last quarter, because the COVID crisis has already started and the lockdown had been instituted, gives you an idea of the kind of impact various sectors are going to face in the coming quarter and when that can ease up. So I've shown the automobile, banks, cement, all the sectors here. As you can see, there are 4 columns there in terms of sales. EBITDA is operating profit, then PAT, and then the change in the margin year on year. So as you can see, by and large, there's an equal division of sales dropping and sales rising. So what is the sales which is risen? Fertilizer and pesticide. We talked about the Kharif crop recently. The other sales is financial services. Why? Because insurance is a financial service product. It's had some good demand here. Healthcare services have seen good demand. IT, as you know, has been having a good outlook because people are now using more of IT products, working from home, consuming Netflix and Amazon Prime and all of that. So these are the ones positive, and telecom naturally follows through. So these are the ones positively impacted by the crisis. Which are the ones negatively impacted? Yes, automobile sales was down last quarter, badly. Banks business was down, cement was down, chemicals were down. So moving from there to what the stock market sees, which is the profit after tax. So there you can see more or less it is red, because in this period, while sales may have gone up, it has come at a cost of a price. So by and large, the economic performance, except for fertilizer and banks, which could improve their profit margin. Why? Because RBI provided a lot of liquidity to them, which they have not lent or dropped the prices. So they are making good profits there. Right? So you can see that by and large, it's been a red story in terms of the profitability. From that perspective, let's look at what happened in March. Right? While the market did not know these results, the market is expected to be a lead indicator. So the moment the crisis came, as you can see, the 1-year return as of March was negative for every single sector. And what I've done here is I've compared it with the December one, which was pre-COVID. And then I've ranked that which fell the most and that which fell the least. So that which fell the least was the FMCG. Why? Because people felt that, market participants, that some amount of demand for the basic necessities of life. Soap, shampoo, hair oil would be there, and hence they didn't expect them to fall as much. So that's why that sector did not fall as much. The second one was healthcare. Healthcare, why? The market expected positive business. You saw that in the quarter sales also it went up. Also that any virus or cure which comes through Indian pharma is expected to get a good share of that business for manufacturing, the bulk drug, right? So that's why that had a relatively lesser impact. Third is consumer discretionary, again for the same reason, like lower end consumption. Which are the worst affected sectors? Realty, yes, obviously work from home means corporate realty would come down. People will not buy houses because they are more locked up at home. So realty was the worst affected. Oil and gas because energy prices were crashing in the crude the world. And third was banks. Why? Because the fear that in a lockdown that people would not be able to repay and they would default. So the government gave a moratorium that when the moratorium ends, ultimately that day will come and they have to pay. So would they be able to pay? This concern on the rising NPAs in the banks made the bank the third worst performing. So I just covered the top three and the bottom three. The rest of it, I hope you have had a time to look at, to understand. So this now in the next quarter has shown a strong bounce back. So as you can see, the 1 month and the 3 month by and large are red, except again banks there and capital goods here. By and large, they are on the green, whereas the 1 year and the 3 year are in the red. So you can see that the V-shaped recovery is reflected in the sectoral. To understand this better, let's compare it in the same format that I did. This time I've compared the March down with the August up, the V-shaped recovery. So as you can see, the 1 year return, not every sector has come to positive 1 year return. There are still sectors which are negative 1 year return. And there are quite a few sectors like IT, tech, healthcare, which are not positive 1 year territory. But what I'd like to tell you is even that which is negative has become less negative. So if you go to the right-hand side columns and look at the V-shaped recovery, you will see that everything is green. Every single sector either has changed from negative to positive or has become less negative compared to previous. That is what we mean by a V-shaped recovery. And here, if you go by the ranking of the recovery, what is number one? Healthcare. Why? As I explained to you previously, both in the controlling the fall and in the rise, healthcare has been the number one winner. Number two, auto. That is a surprise because I showed you the auto. I'll take you through the auto sector earnings also in detail to understand this. But just understand for a minute, the auto sector is number two, the bounce back. Right? What is number three? Metals. Why? Metals are global cyclicals. You'll understand that. Then what are the bottom three? Banks continue to be the worst hit because of the NPA fears. Realty continues to be the worst hit because of the change in dynamics on corporate real estate, and power again continues to be in trouble. So now when we go through, this is the 3 year returns, roughly the same story plays out there. Let's look at each sector in a little more detail. So this is the Bank X. So the 1 year return, the delta, can you see that? The V-shaped recovery, 10.3% is the V-shaped recovery, but in a 3 year, it's still negative. It has lost out. Now down when you look at the quarter four, right? Look at the performance, sales, operating profits, profit after tax, and change in margin. Large cap, mid cap, small cap. Can you see there that larger banks have seen a drop in sales? The smaller cap and the micro cap have seen some growth in business, but they have actually suffered on the profitability front because mid cap banks are negative in their profit and operating profit, and small cap has seen a 148% erosion. So the banking sector numbers are reflecting the outlook, both the past outlook and the expected outlook to be not so great. Next, let's do IT and tech. As you can see, very strong V-shaped recovery, both in the 1 year and the 3 year. And if you look at the large and the mid IT companies are doing very well. They have had their margins also expand a little bit. They've had their profit grow YOY. It's a small and micro cap IT companies which are struggling because the larger ones have the relationships with their foreign counterparts to quickly get onto the new types of businesses which are now demanding, which is what? Cloud-based computing, Internet of Things, management consulting, IT consulting, and all of that. So larger IT companies clearly on a good wicket, and the market is reflecting that too. Next, pharma sector. Again, a winner in terms of the V-shaped recovery. And look at the numbers. not so great, right? Because you had a 50% down in the large cap companies and a 20% down in the small cap companies. But in this case, the market is betting on the future and hence they are ignoring the past performance. That's the pharma sector. Next, let's do the consumption sector. Now, in consumption, I've included auto here because auto, I would say, is the riskier end of consumption. Consumer durables is again slightly riskier, whereas FMCG and consumer discretionary are a little safer. So as you can see here, all of them are relatively in green in 1 year, but the auto has shown the best improvement, followed by consumer discretionary and then by FMCG. What is the reason for it? The reason for that is that despite the earnings, you're seeing complete red. So whether it's sales, operating profit, or profit after tax, both consumer goods sector and auto sector are completely bleeding. That means they've been severely affected with the crisis, both on their top line sales and the bottom line. Despite that, you are seeing a strong sharp recovery. So for you to understand this, what we need to understand is that the market is trying to be a lead indicator of the future. They expect that in the V-shaped recovery, auto and consumer durables will actually lead the recovery. And that's why the market is projecting the future. So naturally, current earnings are being ignored and the future is what they are saying. I expect this quarter to continue to be bad for both these companies, but auto, because it's last year, this quarter was also very bad, you might see an improvement in auto sector performance. But consumer goods, especially white goods like refrigerators and air conditioners, they have been hit at the worst possible time, which is the summer season, when their demand normally goes up. And so their numbers will continue to look not so great in the coming quarter. Right? Then we come to the cyclical sectors. They're all in red. There is recovery, but as you can see, they are still 1 year returns in March were negative. They continue to be negative. There is some improvement in terms of less negative, but they still continue to be out of favor. And that's because if you look at it, I've captured here all the cyclical sectors, that is industrials, metals, energy, cement, and construction. By and large, all you can see is the red color, which indicates that last quarter itself they had a pretty rough time in terms of the economy hitting their sales and the demand hitting their profitability. And hence, even for this coming quarter, you're likely to see the same story repeat itself. And while some amount of liquidity might show some amount of further V-shaped recovery, you will still continue to see a negative 1 year and 3 year returns in the coming quarter also for this sector, right? Services sector again got deeply impacted by this. So I've shown a few of the overall services: telecom, which is a service, medical, media and entertainment, and financial services. So as you know, telecom has had a good time because there's been no competition to Reliance Jio and to Bharti Airtel, and the data usage has shot up in this work from home lockdown kind of environment. So that was a summary of that. And then the miscellaneous sectors like chemicals, textiles, fertilizers, this are all, as you can see, fertilizers the ones which have had a good time, right? Chemicals is a mixed bag, and textiles has been hurt because it's an export-oriented sector, and naturally the world being in a recession has hurt its performance and outlook, right? So giving you now a view of how Sundaram Mutual Fund, based on this, we are constructing our portfolio, because that will give you a clear idea of what I just spoke about. So as you can see, these are the sectors within the NSE 500 index, right? The weightage of each of those sectors is given, where we are overweight in our view, which means we are very positive. So there, if you see, the big change which has happened are in two sectors. In IT, we have moved, we were underweight earlier, pre the crisis panning out, we are overweight now, because clearly we are seeing the world welcoming IT changes now. The second is in the chemical sector, where we were neutral. We think there's a huge opportunity for India vis-a-vis China, and we have moved into our overweight status. So these are the sectors. So as you can see, out of the 100% of the market, 38.7, so 39% of the market, we are overweight. So in the balance 60%, we are either neutral or underweight. And you look at our individual funds, right? They have the flexibility to take a call based on the fund manager's view. But overall, if you look at the changes month on month, you can see that every one of our important funds has added IT because such view has changed positively in this time. We have also added chemicals. So as you can see, by and large, the views that we express are implemented by the fund managers, but the net positions still continue either to be overweight or underweight, because the move is not significant to change their stance, but the direction is what is important to study. So those were the overweight sectors in Sundaram Mutual's perspective. Now we come to where we are neutral. We are ready to hedge our bets, be there, and maybe make a change either way depending on how the situation improves. So here in this category, we have 32%. So one third of the market where we are neutral in our positioning. And you see there, private banks feature there, automobiles feature there, building materials, consumer stationery, retail, and capital goods. All of these are neutral because we believe that medium term there's a good story here, but in the short term there could be volatility. So we are staying neutral. The same holds for our funds. So as you can see here, right, our funds have their own positions vis-a-vis their indices in these, but on this, by and large, though it is red, these are all very marginal changes. So we have not made any big changes in these portfolio in the last month on the neutralish sectors. Now we come to the rest of the market where we are underweight, which means we're negative in our view. What do you mean by that? That's for 28% of the market, a quarter of the market, which are the sectors NBFCs, infrastructure, public sector banks, metals, both ferrous and non-metals, non-ferrous, and real estate and oil and gas. So these are the ones we are underweight big time. And here again, if you see, while we are continuously underweight across all our funds, when in one or two cases we have slightly overweight position, we have also cut those positions in this last month. So the red indicates that we have reduced our respective weights in all these underweights. So as you can see, the proof of the pudding is in the eating. That is, the views expressed by us are being implemented across our funds, and which are a function of the performance in terms of the last quarter and expected performance in this quarter, right? So that ends the study on the economy sensitive sectoral indices, which gives you a view. And why I covered that before I talk about the market cap base is because whether it is an FII or whether it is a domestic fund manager, people look at the economy and the sectors first, decide on the sectoral allocation, and then go and pick a large cap, mid cap, or a small cap, right? So now we will look at how this whole market performance or by the large, mid, and small has been. Before that, please look at the sectoral breakup of the index, because it's important to consider that though we may say, for example, that I am underweight in banks, let us say, the fact is the bank is the largest component of most of the indices, banks and finance. So though I'm underweight, it still means that it's 24.8% of the Nifty is banks. I may be 20%, and so I'm underweight, but it doesn't mean I'm zero. I'm still holding 20% weight. So one of the things for you all to understand is that in the index, which are all the heavy weighted sectors, we have to be present. A fund manager cannot take a total contra call. At times we do that. I'm not denying that, but generally speaking, we can be plus or minus a little bit of the weightage. So please understand that depending on whether it's a mid-cap fund or a large-cap fund or a multi-cap fund, these will be the indices, and this is the sectoral breakup of the indices. So anything that we talk about underweight, overweight is relative to the index weight of that sector. That being said, let's look at first how the COVID fallout was on our indices. So as you can see, as of March 31, 1 year returns and 3 year returns all were in the red. By the arrows of December, the large caps were in the green in 1 year, the mid cap and small cap were red, which is common knowledge, right? And then when you look at the 3 year returns, all were actually in the green in the 3 year returns pre-COVID, all have turned negative. So now when you look at the 1 year return, you can see that the worst affected was the small cap and mid cap because they had a 1 year return of 36% to 32% negative, whereas large caps were only 24% negative. But this negative return is to be compared with the December return. And so when you then look at the COVID impact in the last column, you will realize that actually large caps fell much more in relative terms compared to mid caps. Why? Because FIIs were selling. So I will come to that in a little bit. So this was the impact of the COVID. Now in the post-COVID, right, you all know that there has been a bounce back in the market, right? So when you look at the bounce back, where are you seeing the bounce back? So you look at the 1 month return, it's all green. It's roughly the same. So it's about 3%, 3.8 and 4.9, right? Somewhere around the 3% mark. You look at the 3 month return, you can see that slightly that mid and small caps seem to have done better than large caps, right? The later 6 months, 1 year, these returns affect that. But to truly understand the longer term return, let's use the same format that I used a little bit for. So I've shown you the March down, and then the August bounce back, which is the V-shaped recovery. So as you can see today, the Sensex and the Nifty 1-year return is just marginally negative. Whereas Midcap, BSE Midcap and BSE Small Cap are actually positive. So can you see how dramatically this 1-year thing has changed? Whereas the 3-year has still not changed. In 3 years, large caps are still positive, but mid caps are still heavily negative. So a longer term underperformance has yet to be properly done, right? So from that perspective, right, what I'd like you to note now is the extent of the V-shaped recovery. Right. So as you can see, the V-shaped recovery, actually large caps have recovered the least on a 1-year basis. Mid and small caps have seen a strong recovery in the 1-year return. Yes, it is still negative, but it has come from very deeply negative to much less negative, right? So where I'm trying to see is clearly there is a buying happening both in large caps and in mid caps, but the mid caps seem to have a larger amount of buying. Now, this is not necessarily that more money went there. It is just that the liquidity in the mid cap segment is so less that even a little bit of buying takes up the prices. Okay, so this bounce back from April onwards, right? Sundaram funds have also shown a degree of bounce back. As you can see in our thing, our various large cap, mid cap, and multi cap funds have shown, a small cap has shown a bounce back of 36%, our mid cap has shown a bounce back of 25%, and a large cap 20%, and a multi cap somewhere in between. Though despite that bounce back, the 1-year returns still continue to be negative, right? So now let's look at the reasons for this market bounce back. So let's look at the two main players here. One is the FIIs. So what is the FII flows telling you? FII flows have actually turned positive since April this year. Post the crisis, India has, as you saw in the slide earlier, that $5 billion of money has come into India, 4 billion in the first quarter, and about 1 billion in this quarter 3 to date, right? This money, right? Why is this FII outlook suddenly turned favorable to India? First, the expectation of the V-shaped recovery, and also if you remember in our discussion on long term, we looked at the positive long-term outlook for the Indian economy. This V-shaped recovery is in fact translated, expected. So we are now talking about market expectation of earnings, right? So a large cap Nifty EPS, which has been flat at around 450, which is showing only a 0.2% CAGR, is expected in the next year, that is financial year 21-22, to jump up 50% to 677. So this V-shaped economic recovery is expected to see in the V-shaped large cap earnings recovery. That's one another reason that FIIs are putting money into India. In addition to that, our currency outlook has turned favorable because of the drop in the crude prices, right? That's stability. Second is that rupee 3 months has already started strengthening because the FII flows and the FDI flows which have been coming in just started strengthening. As you can see, about 0.8% improvement, but over 1 year it has almost 8% depreciated already. So expectation of future depreciation is not so great because the long-term depreciation of the rupee is expected to be 5% based on the interest rate parity principle, which is laid out here, which is the difference in the American 10-year rates and the Indian 10-year rates is generally 5%. I've taken 4 quarter ends here to show you. And you look at the depreciation over 10 years, Indian rupee has weakened over 10 years with the long term. So since last year we have depreciated 8%, markets, FIIs are not expecting a further big depreciation because we depreciated more than the long-term average last year. So that's again the positive outlook. Second is from a valuation perspective. Right? From a valuation perspective, right, we can compare with interstate India's valuations with other countries. We can compare with our long-term average. So we'll do both. So when we look at interstate valuation of India, right? What are you seeing here? This is the premium that India has over emerging markets. And because India is a darling of the FIIs, because of our long-term outlook, we've generally been trading, if you see, except for 2007-8, by and large, we've been trading at a premium. Most recently, what happened is that this premium has corrected significantly and taken it below that 35% level which is the long-term premium average for India over the emerging markets, and came down to about 22%. So that for FII said that it's an attractive buying opportunity in India, and that's why you see the new FII flows has taken back that valuation to close to the long-term average, right? So one reason why the FII flows came in is the valuation related support. This valuation result support, now look at it on a past history track record. We saw intersay, now we'll see from comparing with our own long-term averages. So on the price to earnings, we dropped lightly below the long-term average, and the new inflow has taken it back to that long-term average. But the interesting thing is that if you look at the ratio below, which is the price to book, there we are able to clearly see that the price to book is below the long-term average, because the book value of the assets that Indian companies have created, land, building, plant, and machinery, is intact. And so any bounce back needed does not need fresh investment from that 69% capacity utilization to the previous peak of 77 and the earlier peak of 81%. For India to go back to that level, it just needs to produce more. Fresh capacity expansion is not necessary. So this is a positive from that perspective. So price to book as the valuation methodology is showing India to be at slightly better valuations compared to our long-term average. So that's another reason for FII money to come in. Now this FII flow is largely in large cap. So the any rise that you saw, the V-shaped recovery in large caps, is explained by this FII inflow. But this does not explain the sharp rise in the mid and small caps that you saw. So let us look at now at what domestic MFs have been doing, right? Domestic MF flows, let's look at first inflows into domestic funds and then see what the fund managers are doing with that money. So first, if you look at it here, that generally in the equity market data that is published, equity MFs are include the arbitrage category and the ETF category, right? Now, arbitrage is just a hedged equity, so it doesn't go to freshly improve the market. It's largely corporates use that as an alternative to liquid funds. So I excluded that from the top first table. So there you can see for these 3 months, what has happened to MFs? Gross sales is around 16,000 crores a month, roughly. SIP book of that is 8,000 crores, so lump sum is 8,000. So by and large, a steady month-on-month flow of 8,000 crore of SIP, 8,000 crore of lump sum. But then when you take the redemption into account, right? Gross sales of 48,000 crores over the 3 months, 44,000 crores is the redemption. So only 4,000 crores was the net flows available to the equity mutual funds from retail customers. And even in that, if you see the trend, April and May were okay. In June, they actually had a 2,800 crore outflow. And actually, if you look at it, if you take out the SIP book, month on month, these flows have been negative. So mutual funds have not been sitting on huge amounts of cash to go and buy anything. They only had about 4,000 crores. Now, ETFs, in the next table, you see this 4,000 crores, ETFs have generated 8,500 crores of inflows. Now, who's putting money into these ETFs? There are 3 players. One is domestic provident funds invest in ETFs. Number 2, foreign ETFs invest in Indian ETFs when they put money into the Indian market. Third is retail HNI investors. If they want to play the large cap, they put it in ETF because of the cost saving, right? That is the one which has actually got double the inflows of the regular mutual fund. So 8,500 crores has come from ETF. Why I'm pointing this out is this 8,500 crores will also naturally go into large caps. So now when you look at the inflows that the mutual funds got, they got inflows in regular equity, but they lost 7,000 crores in the hybrid category. So balance advantage fund, equity hybrid, these categories have been consistently seeing outflows, and that's why that has led them to the equity component of that. They had to naturally sell in the market, right? And the ETF number, I already discussed it. Now, when you then look at the kind of funds that are managed by the industry, they have about 10 lakh crores. So 10 lakh crores, 31% is dedicated large cap funds, 38% is multi-cap funds, and 13% is hybrid funds. Mid-cap funds and small-cap funds are only 8% and 4%. Because what are we looking at this data for? We're trying to find out why mid and small-cap stocks have been rising. So are mutual funds the ones who are buying that? Where can they buy it? They can buy it from the 8% of mid-cap, 4% small-cap. This is the existing AUM. Or they can allocate something from the multi-cap. So now on the right hand side, you look at the flows, inflows, and you break it up. As you can see, mid and small cap put together have got less than 2,000 crores of inflows. Multi-caps have got 6,500 crores, so some amount of that can go to mid-cap. So if you now attribute a general percentage to each of these, you will see at the end result that 74% of the inflows are meant for buying large caps. Only 18% are meant to buy small cap, mid caps, and only 8% small caps. So to summarize the data, the existing assets under management of the 10 lakh crores, just 22% plus 10%, that is 32%. One third of the 10 lakh crores they can buy, and they have already invested it in mid and small cap. This is what accounts for the current buying. The new sales, only 18 and 8%, which is only 2,500 plus 1,100. That's all that is available to them to buy mid and small caps. Now, with that money, at least that much, did they buy, or did it all go into large cap, or what did they do? So now here is the story. In the Q1, when FIS was selling, mutual funds were buying. So when FIS sold 48,000 crores, mutual funds stepped in and bought 39,000 crores. They probably bought it after the fall or something, because that's why, despite that, there was a strong correction in the market. So mutual funds by and large, but or they bought it before the fall and some further fall too. But in the new April, May, June, and then you take this Q3, July to now, mutual funds have been net sellers in the market. In the Q2, they sold 2,000 crores of stocks, and in Q3, they sold 5,700 crores of stocks. So total almost 8,000 crores of stocks mutual funds have sold. So while they did have money to buy, which is how much? Just to take you back to this slide, they had 4,000 crores net money in the quarter to buy. But on the contrary, what have they done? They have gone and sold 8,000 crores. So as you can see, mutual funds are actually, whatever inflows they have are keeping it in cash. They are not going and buying things in a big way. So they are not the answer to why mid and small cap are rising, and why are mutual funds being net sellers. They are net sellers because when you look at the last year's earnings pattern of large cap, mid cap, small cap, you can see that mid caps have been most damaged and small caps, right? 84% negative PAT growth, 48% negative PAT growth. This is last full year. Last year, last quarter, which is what is predictive of this quarter, even worse. Mid caps are down 58%, small caps are down 167% on the earnings. Now, this is expecting this quarter to be bad, but some companies have already reported in this quarter. And so you see the breakup here for about 311 companies. You are seeing that small caps are again negative. Large caps are also negative for this quarter. And a few of the mid-cap companies, 44, happen to have shown a positive growth. Though on the sales, all of them have been deeply hurt by the lockdown and the COVID crisis. So as a result of this, mutual fund managers who are fundamental managers are not very encouraged to go and buy, because this quarter's result, as it pans out, they expect it to be quite bad in terms of results. So domestic MF behavior also does not explain the sharp rise in mid and small caps. What explains it? What explains it is the lockdown, which has led to a lot of people having a lot of time on their hands. And at the upper middle class and the richer people, they have not faced any cash flow shortage. So they have started directly trading and speculating in the stock market through brokerages. This gives the top brokerage houses of the country and compares the March number of clients to June this year. That is 1 year and 3 months. As you can see, Zerodha has doubled its customer base. 5paisa Capital has quintupled its customer base, right? A lot of other companies have shown strong growth. So in this time frame of lockdown, retail customers have gone and started buying stocks. Or you may say, what are they buying? Part of it they have put in ETFs. You saw 8,000 crores was the inflow in ETFs. So those of a safer mentality have gone and purchased ETFs, which in turn has gone into the large cap stock. But the rest of the people are actually just speculating and punting. So they are called as Robin Hood investors. Because what are they doing? They are following Z Business and CNBC Awas and seeing that this stock is at a 52-week low. This is at a 104-week low. So buy it. You can't go wrong. And the evidence of that is seen in this. Look at the number of penny stocks which have in these 3 months shown a 5 to 7x multiplier. We are not talking about percentage returns. We are talking about multiplier in the stock prices, right? And either they are hot cakes or they are hot potatoes. So this kind of a buying is what has taken up the small cap and the mid cap index. As a result of this, right, those indices are up, and these people are definitely not long term. We have to see how they behave, because as this next quarter's earnings comes up, a lot of the promise behind these names, if they don't translate, they will be the first to sell. So definitely we are in for a period of volatility in terms of the small and mid cap segment, because these people have entered the arena. And all they are doing is they are substituting their horse racing or any other gambling instincts by taking advantage of the zero brokerage or low brokerage, 5 paisa brokerages, and just going and trading these stocks. So that explains to you. And these brokerage houses, which are not giving them free, have shown a strong increase in their earnings, because there are some people who are going to a brokerage which is charging them fees, right? So thus, to summarize, the stock market is showing this bounce back after the March correction, expecting a V-shaped economic recovery, but supported by strong FII flows, strong ETF inflows, and strong retail direct equity inflows. So now, when we now look at the valuations consequent to this jump in price, you will see that the large caps from the previous market peak of December 17 has actually gone up by 1.2 to 19x. Though the EPS expectation, if you see the second last column, is down by 1.4%. So clearly large caps are entering a slightly rich valuation territory, because on the previous market cap, they're trading at a higher PE, but with a lesser earning expectation. Mid cap index was at 24 PE then. It has corrected 8x to 16 PE. But this correction has been accompanied by a 10% improvement in earnings expectation. So mid-cap's earnings actually expectation has gone up compared to what it was in December 17 by 10 percentage points. Still, there has been a correction. Why? The reason being that the rationalization of schemes announced by SEBI post to that meant that a lot of fund managers were forced to sell off the mid cap they held in their large cap and other funds, and hence that has led to this correction in the valuation. In the case of small cap, yes, there is a correction in the valuation, but that is more or less justified, because the economy going into a slowdown means that earning expectation also is down by 15%. So as a result, if you look at it from a calendar year perspective, today the mid cap index is trading at a 16% discount, small cap index is trading at a 17% discount. So from a longer term valuation perspective, they have corrected quite sharply, and there is a reasonable amount of undervalued status in the mid cap and the small cap. And in fact, for looking and evaluating that, you have to look at a slightly longer period of time. So this year, financial year 20, obviously the valuations are looking very rich. Financial year 21 also, large caps, because of the prices, are looking rich. Mid and small caps are slightly lesser. But when you look at the next financial year, which is 21-22, you see large caps are likely to come back to the long-term average, but mid and small caps are definitely trading at reasonable valuation. All of this is, of course, factoring in that a V-shaped recovery would be in place at the end of a year. Right? So all the three indices are trading at and around their long-term averages. And if you look at it from the price to book calculation, which I showed you earlier on the large cap, the mid cap is also trading at a discount to long-term on the price to earnings and on the price to book. And the small cap is trading at long-term average on the price to earnings, but at a discount on the price to book, right? So from that perspective, right, for a mid and small cap, while I'm showing you a positive valuation story there, you got to remember that the V-shaped recovery has to happen, because Mid and small caps only do better in economic upcycles. So this graph here, which is for the Sensex, the mid cap, BSE mid cap, and the BSE small cap, there are 4 parts here. Let's discuss the last 2 parts because the previous 2 parts are long time back in history. But the same thing is being repeated here. So if you look at what is the period between 2013 October, when it's roughly when Mr. Modi came to power, 6 months before that, to December 17, which was the peak of the market. We'll call that a virtuous cycle, right? The economy was on a good wicket and the stock markets were reflecting. You can see here how clearly that while the Sensex went up 12% per annum, mid cap index went up 29% per annum, small cap index went up 33% per annum. So clearly the headline there is that mid and small caps do better in economic up cycles. But you take the next down cycle, which started from December end of 2017, went through the negative food inflation, the NBFC crisis and all of that, and now the COVID crisis. You can see that the Sensex has got a positive 4% return despite the economy being in downturn. Why? Because FII still believes the long-term story, have been putting money into India, and mutual funds also, 74% of their AUM is in large cap stocks. So that is what has held it down. But mid cap index corrected 10% and small cap index is corrected 40%, right? So the reason I say this is that right now we are in that downturn. Now, if you go and look at the graph and the extreme end of the graph on top of this picture, you can see that there's a small uptick that is being seen. Now, time will tell us whether this uptick, which is indicative of the V-shaped recovery, is a sustainable one and the V-shape will get formed, or it is going to take some time through the form of a W. So there are some market participants are calling a V-shaped recovery clearly in the mid and small cap, but some are holding their horses. So it's better to be on the safer side. The same story is true when you come to the Nifty related indices. Their stock compositions are different. That's why I showed. So the Nifty 50 has only gone up 2%, whereas Sensex went up 4%. But the fall, there it was 10, here it is 11, there it was 14, here it is 21. So mid and small caps will do better. So why I'm telling you this is when I'm going to talk about asset allocation and investment, right? Please bear this in mind. Right. So now I move to the last section, which is the investment strategies, right? From a domestic asset allocation strategy. The first things first is the customer's risk profile is critical to know. So I have classified them into 3 types: aggressive, moderate, and conservative. Right. Now, what I want to show you is that these long term, the trend of a fund manager managing a fund. Why I'm suggesting this, when I'm talking to you about asset allocation strategies, right? So I'm trying to also show you the advantage between putting your money in a direct stock, putting your money in an ETF or an index fund, and putting your money in a managed fund or an actively managed mutual fund. So I want to demonstrate to you the long-term benefits of using the mutual fund through the firm with the help of an advisor. So here, if you see, I've taken our large cap fund because this kind of a detailed analysis you cannot do for the whole market, which is called a rolling returns methodology. So what I've done is to show you that this fund underwent a change of fund manager in third quarter of 2016. So I've taken the data from his time onwards. As you can see, the average return, the first line, in a 1-year period, is done better than the benchmark. 2 years is flat, about the benchmark. 3 years is done 1% better than the benchmark. And when he's done it well, he's delivered 6% alpha over the benchmark in 1 year, flat over 2 years, and 0.8% flattish over 3 years. But the max loss, he is protected by 4% in a 1-year time frame, as is also what flat in the 2 year, in the 3 year. So first is in terms of how does he deliver returns to you on an average at very good times and very bad times. The next is the probability analysis, which is again equally critical. Number of times in a 1-year return that he beat the benchmark, that is the alpha. So can you see in 1 year, 57% of the times he beat it, 43% he did not beat. 2 years, 44%, in 3 years, 90%. So what I'm trying to say is the longer you wait, the better the chances that a managed fund. So if your outlook is for a longer term, in the large cap space, I am suggesting to you that a fund can always do better. And then when you see here, The percentage of positive returns are about close 79 versus 81, 83 and 83, 97. So again, when you go to the 3-year period, 97% of the time the fund has delivered positive. Only 3% has the capital got less than what the investment was made. And you look at percentage of beating inflation, 1 year for 60% of the time, 2 years about 60% of the time, 3 years he's done slightly better than the benchmark. So in the large cap, which is the most challenging space because there's a lot of ETF money going in, there's a lot of FII money going in, the most challenging space for a fund manager to deliver alpha, you can still see that if you wait 3 years, you still have a good chance of getting better than doing a passively managed index or directly buying large cap stocks. When you come to the mid cap, since the mid cap fund has been in excellence for a long time, I've shown a 15-year. And as you can, I would draw your attention to the third column, every third column, because that is the difference between fund and benchmark. And the fact that every third column is in green tells you that the mid-cap fund on a rolling return methodology, on an average return, has beaten the benchmark 1 year, 3 year, 5 year, 10 year, 15 year. The max return, he has beaten it at 1 year, 3 year, and max loss. And you look at the probability of beating the benchmark. In 1 year, 68% of the times. In 3 years, 77% of the time. But in the 5 years, 95% of the time, they have beaten the benchmark. And once you rate for 10 years, 100% of the time, the fund has beaten its benchmark. And then when you look at the positive returns percentage and the inflation beating percentage, the greens indicate to you that consistently the fund has been able to do better than the passively managed index, or if you start running stocks on their own, also it is better. So I hope I'm trying to drive the point that any mutual fund over a medium term time frame is a better bet to put your money in. In the small cap, which is a high risk, high reward bet, right? And fund manager puts in 40 to 50 stocks, there are more than 300 to 400 stocks there. So the chance for a fund manager to go wrong are very, very high. Despite that, look at it again, greens all through on the average returns, greens all through on the maximum returns, and except for that 1 10-year bit where it was slightly less in terms of the maximum loss, it's greens all through. And when you go to the probability factors, 1 year is 63% of beating the benchmark, but 3 years itself, 80% of the time it's beaten the benchmark. And once it goes to 5 years, 100% the fund manager is able to beat the benchmark. And you can see greens in terms of the positive returns and beating inflation right across. I hope I have made the case to you of choosing an active fund manager versus a passive index. And what we remember, we saw these good cycle, bad cycle kind of a graphs for the index. Say compare the fund with the index. Can you see here the large cap select focus has beaten the Nifty in the virtuous cycle by 2%, and in the down cycle is matched the Nifty. The mid cap fund, as you can see, has done 6% better returns annualized than the mid cap index, and it's just about 1% less in terms of the loss protection in the bad cycle. Whereas in the small cap fund, he has given you 9% better return, 39 versus 30 on the good cycle, and he has protected your downside to the extent of 3%. So with all of these data, I just wanted to make a point that in choosing your asset allocation or any medium-term allocation, always rely on an active managed fund manager. As you can see, the data shows that they do deliver value to you over the medium term. Now, on that basis, in mutual funds, when you invest, if you are an aggressive risk reward investor, at this point in time, given the COVID uncertainty, I would suggest even for an aggressive player, a 5-year horizon is key. Because while a V shape is expected, market has started discounting, you're seeing there is some flattening, there could be a W forming, and hence when you look at it over a longer period of time, definitely the value will arise. But that timing is a little bit uncertain, so do not have a shorter time horizon in your investment philosophy. Number 2 is flexibility is the key, because the market is discounting the V, but we don't know whether that's going to really sustain in a continuously V. But in 1 year's time or something, I think that the V will be clearly visible. So I suggest that you need to maintain flexibility. But today, I would say you err on the side of safety towards 50% large caps, mid caps, which are I would say roughly 20% safety, 80% thing. So another safety element through mid caps, small cap being the highest risk, right? And after 1 year, be prepared. Now this 1 year is not sacrosanct. It could go from 9 months to 18 months in terms of the time frame. Then you have to be prepared to shift into a slightly riskier portfolio. So that flexibility is key. Now, when you choose such a fund, please choose those funds which are ethically in that space. What I mean is a large cap fund. For example, our focus, 85% is in large cap. So when you're buying large caps, you have to make sure that they are not adding mid caps there too much to make your own asset allocation a bit confusing. So similarly, in a mid cap, for example, our mid cap is 70% in mid cap and 15% in small cap. So it's at the small end of the cap now. Our small cap is 85%, it has zero large caps. So one of the things that you should also look at is that when you choose this asset allocation, make sure that the funds are also managed to that mandate. Otherwise, if they are taking long cash calls, long things, then your own confusion will arise, right? Like, so we have got 8% cash today in focus. This is a large cap fund, so it's easily deployable, right? So that's one point of view from that perspective. The other option, which you're very aggressive, is that you say, oh no, I want to take sectoral calls and invest. But again, 5-year horizon and that flexibility. So here I would say that choosing sectoral funds, your banking, IT, pharma, and half of consumption, FMCG, which is safer, should be about 50%. So 40 there, about 10 to 15. Yeah. And then you take the services, which has got badly damaged in the lockdown, but which has got a good potential for a V-shaped recovery, and infra, which is clearly a longer term bet, as a smaller allocation. But in a year's time, kindly be prepared to increase those riskier allocations and shift your thing. So this again, like I said, please bear in mind, 5-year horizon, flexibility, right? Now, if you are not of that aggressive bent of mind, and if you have a moderate position, before that, I just wanted to tell you again that how sectoral funds themselves carry the cap curve situation. So they also try to play that safety more or risk more. So if you see here, the services fund is today playing 60% in large cap, which you can roughly call safety, and 6% is in cash. So roughly he's about 70% in a safer zone. Take the rural and consumption fund, it's 55 plus 2, 58% in the safer zone. Whereas infra is 44% small cap, 24 mid cap. So about 68% in the risky zone. Whereas financial services, they're betting on the bigger banks. So 80% is in the larger cap banks and financial service companies. So within the sectoral funds, before you allocate money, just look at what they are doing, because they should fit with the overall allocation pattern in terms of 50% in safety, 30% in medium safety, and 20% in risk. So please make sure that that allocation fits. That's why studying this is also important. I wanted to reveal that to you. Now, if you're a moderate risk investor, because flexibility is important, it's best to let the fund manager do the asset allocation. So as a moderate investor, rely on the multi-cap category. It's large and mid-cap, multi-cap, diversified, whatever, right? Why do we do this? Because there the fund manager has a license to buy how much ever he wants of large cap, mid-cap, or small cap with certain small constraints. So he can vary the cap curve allocation and the sector allocation based on the view. As I said, today you should err in safety, which is what we are doing. So today in our Sundaram's multi-cap funds, we have anywhere between 60 to 78% in safe large caps, and only the balance in mid and small caps. But we have the flexibility that as we see the V-shaped forming properly, as we see the FDI coming in, new capacity creation happening, we are well positioned to switch and add to the mid and small cap. So you can rely on the fund manager. You don't need to worry about it. And taxation doesn't affect you, because if you are investing in your funds in 1 year, you'll say, Arey Baba, short-term capital gains versus long-term capital gains, can I not wait for a little bit? Fund manager doesn't need to bother. When he feels the timing is right, he will automatically shift the allocation. So that's the advantage of multi-cap funds. And third, if you are, and I wanted to demonstrate to you our large and mid-cap fund, we had a change of fund manager there too. From that time on, as you can see, 1 year and 2 years, which is where the time frame, he has done better average return than the benchmark, better maximum return, and protected your loss also better. And the same with the 2-year period. And if you look at the number of times that he has beaten the benchmark, in 1 year, 84% of the time, and in 2 years, 77% of the time. And then when you look at the percentage of positive returns, is 5% better in probability than the benchmark, and 16% better in probability in delivering inflation-beating returns than his benchmark. And the same holds true in the 2-year period, where he's 4.7% and 9.8% better. So clearly, you are better off, because I don't think you do have a choice here, because there are no multi-cap ETFs or anything. So definitely relying on a fund manager, good quality fund manager, will add value to you. Now, if the attitude is of very conservative, saying, I know there is volatility, I don't want to take the chances of a loss, then what do I do? Then again, let the fund manager do it, but do it in what is called as the hybrid category. And hybrid, there are various types of hybrids. At the top end is the equity hybrid, which is about 65 to 70% in equity and balance in debt. At the bottom, you have the debt-oriented hybrid, which is 65 to 70% is debt and 30-35% in equity. So it is at the other end. In the middle, you have equity savings, which has a fixed 30-30-30, with that 10 being the only flexibility to all the 3 asset classes. The third asset class being arbitrage, which gives you equity taxation without the volatility of equity and the returns of equity, obviously, right? And balance advantage, where the fund manager has a flexibility to choose how much in equity, how much in debt. But the reason I'm suggesting this for the conservative investor, because the fixed income component will never be zero. So that will help you to reduce the volatility, because they don't go through wild returns. You'll get anywhere between 3 to 7% returns, depending on the kind of portfolio. But that will reduce the volatility of your fund. Your NAV will not go up and down so much. That's one advantage of this straight away. Second is that the equity component is a multi-cap component. So fund managers can play more safety, more risk, depending on the debt, but their approach will be to protect you. So from that point of view, if you look at our, Sundaram has these funds which are in the multi-cap hybrid space, equity-oriented funds. Only arbitrage, you can leave it. It's mostly, like I said, arbitrage debt. But equity hybrid, balance advantage, and equity saving. Can you see there how the equity hybrid and balance advantage has 55% and 58% in large cap, from the 71-65% in equity? So clearly they are erring on the side of safety today, putting more in safety, but they are well positioned. So today the equity hybrid has a 4% small cap exposure. The balance advantage has about 6% mid cap exposure. He can't raise it if the V-shaped curve forms very well and the outlook is positive. They can marginally increase it to give you a better return. As you know, all these hybrid funds are essentially trying to give you a FD plus kind of a return, which this kind of an can help it. So for a conservative investor, stick to the hybrid category, right? Thank you very, very much for patiently listening to me.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.